Hi everyone. So a lot of you have asked me to make a video on PE ratio to explain the PE ratio in detail. So here I am bringing a full video on PE ratio. So we will start with what is PE ratio, basic formula of PE ratio. Then we will move to significance of PE ratio. Then we will do some industrial analysis of PE ratio, how PE ratio matters in industry. The fourth topic that we are going to discuss is the different types of PE ratio. There are two major types of PE ratio. We'll discuss both of them and we'll discuss one major anomalous type of PE ratio also. Next, we are going to discuss about how to use PE ratio in decision making about a company. And finally, we are going to talk about a few industry examples to wind up this video. So make sure you watch this video till the end, because by end of this video, you will be able to understand how to use PE ratio on real world industry data. So let's get started. So let's start with the definition of PE ratio. PE ratio basically means price to earnings. Now, price of what and earnings of what? Price of a share divided by earnings of a share from a company is what is PE ratio. To calculate PE ratio, what we basically do is we take the market value of the shares of the company and then we divide it by EPS value of the company. Very simple formula. Let us talk about significance of PE ratio. PE ratio, if it is low, what does that signify? PE ratio, if it is high, what does that signify? And when can we say PE ratio is low or high? So first of all, PE ratio is different for every industry. PE ratio is not a common thing across industries. Every industry has their own PE ratio. So the first thing that we do is we identify average PE ratio of an industry. So what we do is basically we take 8 to 10 top companies of an industry. We take the PE ratio of all of them and we calculate the average PE ratio. The PE ratio of a company, if it is higher than the average PE ratio of the industry, then the stock prices of that company are overvalued. It is considered to be overvalued. If the PE ratio is less than the average PE, then it is considered to be undervalued. Now, let us understand why it is called undervalued and why it is called overvalued. So, let's start from the very basic point. Let me show this to you with an example. So, what we are going to do is we are going to analyze two cases. Okay, so let's start with first case. Now, let us take example of a company which has issued 50 shares. Let's say the market price of one share right now is 200 rupees. And this company has made a profit of 5,000. What is EPS? Earnings per share. Earnings per share is basically net profit divided by total number of shares. In this case, net profit is 5,000, which we divided by 50, which is the number of shares. EPS is coming out to be 100 rupees. Now to calculate the PE ratio, we divide the current stock price, current market price of one share, which is 200 rupees, by EPS, which is 100. The PE ratio is 2. Industry average PE ratio is 20. Now, why would we say that this stock is undervalued? Now, when will PE ratio be low? Either the stock price is low or the EPS ratio is high. If the stock price is low and EPS share is high, what does that mean? That means this company was probably not performing well earlier, because of which the stock prices have gone down. But in recent years, this company has started doing well, because of which the earnings per share of this company have gone up. But this recent change of fortunes have not got translated to the stock price. That is why the PE ratio is low. This good EPS will gradually make sure that the company's stock value increases. That is why we say that the stock is currently undervalued. Now coming to the opposite situation. Let's look at the example again. Look at case number 2 now. Let's say there is another company which is into same line of business. Again, 50 shares. The market price per share right now is 10,000. The profit of this company again same as the first company, which is 5,000. Earnings per share will be same, obviously. The PE ratio in this case would be 10,000 divided by 100, which is 100 rupees. Now, industry average in this case also is 20. Now, why are we saying this company's stock is overvalued? Because at the back end, this company is not able to show that kind of a profit. So there is some hype which is getting built about this stock. gradually market correction will happen, stock prices will come down. So that is why we say this stock is overvalued. Let's take another example. If the company's stock value remains the same but EPS is very low, in that case also a low EPS will drag down the stock price value. Again, with the existing situation, this stock is overvalued. So high PE ratio shows us that this stock is overvalued. Low PE ratio shows that this stock is undervalued. If a stock has high PE ratio, it does not mean you should not buy that stock. We have to look into more numbers. We have to analyze more ratios. If a stock has low PE ratio, then yes, this company maybe I will analyze further. It is a positive sign. Talking about the industry interpretation of PE ratio. PE ratio cannot be negative. PE ratio is either positive or zero. Zero PE ratio means a company is either loss-making company or it does not have any income. Now there are two types of PE ratios, trailing PE and forward PE. Trailing PE is basically dividing your current stock price with the last 12 months EPS. In general, when we talk about PE ratio, we talk about trailing PE. Forward PE is basically opposite of trailing PE. In forward PE, what we do is we divide the existing stock price with next 12 months estimated earnings per share. Basically, in trailing PE, we consider past 12 months EPS. In forward PE, we consider projected next 12 months EPS. So a basic analysis, if the forward PE is less than trailing PE, this implies the analysts are expecting the earnings to increase. If the forward PE is more than trailing PE, this implies that analysts are expecting earnings to decrease. Now let us understand how to use PE ratio in your analysis, or how to use PE ratio to make up your mind if you want to buy this share or not. First thing that you will do is calculate the average of that industry. So if you see on the screen, I have shown you data of pharma industry. Let's start with this and we are going to analyze Biocon. Now we see Biocon is the 6th largest company in pharma sector by market cap. Quite a big company. Now let's go to EPS. But as we see, the EPS is very low. EPS of this company is 2.55. 2.55 EPS is very low number. You consider the industry average, which would be much higher than this. So that gives us an idea that this company is a big market cap company, but it has been facing some losses in the past few years. That is why EPS has gone down so much. Now let's consider PE ratio. PE ratio is 157, which is much higher than even the biggest company by market cap, which is Sun Pharma. This stock is so overvalued. Why I can say this stock is so overvalued? This low EPS has not yet translated into the low stock prices. This company is having the advantage of its traditional reputation. So high market cap, low EPS, high PE ratio means this company's market cap and share value, share prices, both will go down because there is no earnings to back it up. There is no profit that this company has to back it. Let's wind up this video with a few industry examples. Let me show you two very good industry examples of specific PE ratio. Let's look at the example of HUL and Colgate Palmolive. You look at the EPS of both these companies. EPS of Colgate Palmolive is 34 while EPS of HUL is 31. You look at the difference. EPS of HUL is lesser than that of Colgate Palmolive. Now check the share price. Share price of HUL is 2241 while share price of Colgate Palmolive is 1592. Such a difference. Price of HUL is higher, EPS is lower. Price of Colgate Palmolive is lower, EPS is higher. Now we look at the PE ratio. PE ratio of Colgate Palmolive is 46 while that of HUL is 71. Huge difference. HUL is highly overvalued as compared to Colgate Palmolive. Now, does that mean we should not buy HUL and we should buy Colgate Palmolive? This we are going to learn in the next video, which is about ROE and ROCE. These two concepts will help us in refining our stock buying strategy even further. So for now, what we understood is PE ratio, the basic definition, share price divided by earnings per share. Lower PE value shows the stock is undervalued. High PE value shows stock is overvalued. Zero PE ratio basically means the company has either zero profits or it is a loss-making company. Trading PE ratio basically is your existing stock prices divided by last 12 month EPS. Forward PE ratio is existing stock prices divided by forecasted next 12 months EPS. We learned about how to use PE ratio to analyze two companies of same sector. That is all about PE ratio. If you have any questions, type in the comment section. I will definitely answer those questions. So stay tuned to the Developing Investment Acumen videos, and I'll see you in the next video.